Welcome back to Wealth Pathway. This is a narrow path to the truth, and I am your guide. Please close the door. It is too noisy outside. We need some absolute silence to dissect the elephant in the room. Everything you are seeing. Now, the new highs in gold prices, the restlessness of silver, all that anxiety in the headlines about geopolitical conflicts and rate cuts, these are just ripples on the surface. The real tsunami is happening on the seabed in the deep ocean where there is no light, only massive pressure differentials and tectonic fractures. In today's report, I am not going to give you any so-called wealth codes. Those are placebos for gamblers. What we're going to do is dissect, with surgical precision, the structural collapse currently happening in the global monetary system. This content is long, even a bit dry, but I promise you, when you patiently finish reading every last word, you'll understand more clearly than 99% of the people in this world where global capital will flow in the next decade, and why those fiat currencies in your bank account, whether dollars, euros, or yen, are undergoing an irreversible euthanasia of purchasing power. Gold and silver have both hit all-time highs. Looking at that price, what is your gut screaming at you? Your prefrontal cortex is telling you, too late. I missed it. Getting in now means being a bag holder. This is the typical psychology of retail investors' fear of heights. This is the human weakness that Wall Street and the City of London love to exploit the most. But there is a logical paradox here, a massive cognitive black hole. If the price is already too high, why are central banks the ones with access to the world's top-tier data and teams of the sharpest analysts from Harvard and Yale buying gold at an almost panicked pace? Let me give you a set of cold, hard data. This isn't a prediction. This is something that has already happened. Last year, global central banks bought over 1,000 tons. What does that mean? This is the highest purchase volume in modern financial history. The last time we saw such aggressive, such cost be damned official gold buying frenzy was in 1967. For those familiar with monetary history, the year 1967 should send chills down your spine. It was on the eve of the London gold pool collapse, the prelude to the complete disintegration of the Bretton Woods system. The night before Nixon was forced to close the gold window, and the global monetary system plunged into a decade of stagflation and chaos. History doesn't repeat itself exactly, but it always rhymes with the same meter. Did the elites back then know this was about to happen? Of course. Do today's central bank governors know something we don't? The answer is yes. They buy gold not to hedge against inflation. That is a story financial media uses to fool kids. They're not doing it for investment returns either. Central banks don't care about those price spreads. At this level of the game, gold isn't an asset. Gold is power. It is sovereignty. It is the nuclear weapon at the global monetary reset negotiation table. They're stockpiling chips for a post-dollar era. If you only see price fluctuations, you are the liquidity provider. If you see the transfer of chips, then you are a player in this game. Behind this is a key driving force deliberately ignored by mainstream media. This is Basel III. This is a set of global regulatory standards established by the Bank for International Settlements, the central bank of central banks, after the 2008 financial tsunami to prevent the banking system from collapsing again. For the past few decades, gold has been classified as a Tier 3 asset on bank balance sheets. What does that mean? It means in regulators' eyes, gold was viewed as a high-risk speculative asset with an extremely high-risk weight valued at only 50% or even lower. For banks, holding physical gold was a penalty on the balance sheet, a capital burden, far less worthwhile than holding us treasuries or cash. This is also why over the past few decades, the Western banking system preferred holding paper gold derivatives rather than physical gold. But the rules have changed. This is a revolution without gunpowder. Under the new rules of Basel III, physical gold has been reclassified as a Tier 1 asset. Got it? This means on bankers' books, physical gold is now equivalent to cash, the highest quality asset with zero risk weighting. This is the most significant elevation of gold status in the official financial system since 1971. This isn't just a change in accounting standards. This is a deafening signal. Paper credit is no longer safe. Only physical is king. Europe's banks implemented it. Asian banks followed. But guess who was absent? America. U.S. regulators postponed the implementation to January 2028, citing banks need more time to prepare. Why the delay? America's gold market, especially COMEX, is a paper gold empire built on massive leverage. The gold traded here, the vast majority are futures contracts without physical backing. It is air, it is promises, it is a numbers game among bankers. If the United States immediately implemented Basel III, requiring banks to hold physical gold to match their book assets, it would trigger an epic liquidity squeeze because there simply isn't that much gold bullion in inventory. Behind every ounce of physical gold, there might be 100 to 200 ounces of paper gold contracts in circulation. This is a massive game of musical chairs. And when the music stops, only 1% of people will get a seat. The US delaying implementation is just buying time, trying to let the big players exit in an orderly fashion before the music stops, leaving this hot potato for the clueless retail investors around the world. But the whole world is watching. Even the smart investors on the street know it in their hearts. That is why money is flooding into the physical market like crazy, while the paper market is becoming increasingly irrelevant. Countries are shipping their gold stored in New York and London back home. Germany brought theirs back. Poland brought theirs back. Turkey brought theirs back. Even the story of Venezuela wanting to bring theirs back but being refused by the UK has become a huge warning advertisement. If you don't hold it, you don't really own it. This is preparing for the worst-case scenario. This is casting a vote of no confidence in the current fiat currency system. Let's zoom out and look at the geopolitical landscape. The core of dollar hegemony lies in the petrodollar system. The logic is simple. You want oil. You need dollars first. This forces countries around the world to stockpile dollars, artificially creating unlimited demand for the dollar, allowing the US to print money recklessly and export inflation to the rest of the world. But this contract is being torn up, or more precisely, being marginalized. Look at what has happened over the past 2 years. Major oil-producing countries have started openly discussing accepting other currencies for oil settlements. Emerging market countries are bypassing the dollar, using local currencies for bilateral trade. A settlement mechanism based on non-dollar currencies and gold is taking shape. This isn't just simple trade friction. This is a divorce in the global monetary system. More importantly, there is the expansion of BRICS. They're not just a loose club. They're building a payment system parallel to SWIFT. And in October 2025, a project codenamed the Unit surfaced. This is a trade settlement unit backed by gold 40%, and a basket of currencies 60%. Its purpose isn't to replace the dollar's circulation on every street corner. You are not going to take this to the supermarket to buy milk. Its purpose is to cut off dependence on the dollar in international trade settlements. For any country highly dependent on energy imports and foreign trade, this signal is crucial. The world used to be accustomed to earning dollars, saving dollars, using dollars to buy resources. But what if resource countries stop accepting dollars in the future? What if your dollar foreign exchange reserves suddenly shrink This is why central banks around the world are buying gold. They're doing de-risking of their balance sheets. This isn't conspiracy theory. This is the highest principle of risk management. If gold is the king of currencies, then silver is the seriously undervalued industrial heart. You've probably heard many stories about silver price number manipulation. Most of them are true. But what I care more about is the most fundamental supply and demand basics. Silver is different from gold. After gold is mined, the vast majority gets locked in vaults or turned into jewelry. It doesn't disappear, it just changes where it is stored. But silver gets consumed. It is the metal with the highest electrical conductivity, the indispensable lifeblood of modern technology. The global green energy transition is devouring silver. Solar photovoltaic panels account for 16% of global silver demand, and it is growing at double-digit rates every year. Every solar panel gleaming on a rooftop is permanently locking up a few grams of silver. Silver that won't return to the market for decades to come. Now let's look at electric vehicles. EV. A traditional fuel vehicle needs 15 to 28 grams of silver, while an electric vehicle needs 25 to 50 grams. With the application of AI and IoT in vehicle systems, this number will only increase. Even more critical is the global semiconductor supply chain. Whether it is advanced AI chips or ordinary consumer electronics, the packaging process requires high-quality silver paste. Without silver, there is no highly conductive connections, no computing power, no modern life. Demand is exploding and mine production is declining. The ore grades of many top silver mines are depleting. ESG policies are restricting new mine development, and geopolitical risks are causing supply chain disruptions. This has led to a massive physical deficit. This is why Asian buyers are willing to pay a premium of $35 above the COMEX paper price to snap up physical silver. You want to take delivery at the London Metal Exchange. Good luck. Warehouse inventory has dropped by a staggering proportion. This is a classic prelude to a bank run. Paper prices are still being artificially suppressed by CME Group through raising margin requirements, trying to force out leveraged traders and cover up the truth about supply shortages. But physical prices are decoupling. When industry, those tech giants and automakers, suddenly realizes they might not be able to buy enough silver to keep their production lines running, prices will no longer rise linearly but explode vertically. This is what is called a short squeeze. And this time, it is not retail investors being squeezed. It is industrial giants who have no choice but to foot the bill. Now, what does this upheaval in the global monetary system mean for you, an ordinary global investor? Whether you are in Europe, Asia, or the Americas, you face the same risk. The purchasing power of fiat currency is being diluted. Government debt has reached a point where it is mathematically impossible to repay. And they have only one way out: inflation. This isn't a simple CPI data issue. The traditional 60% stocks, 40% bonds portfolio has become obsolete in an era of high inflation and high interest rate volatility. Bonds are no longer a safe haven, and stocks face the risk of valuation corrections. What you need is an asset without counterparty risk. So on the eve of this turmoil, what should you do first? Redefine risk-free. If you are still keeping most of your cash in the bank, thinking that is risk-free, you need to wake up. Under the double whammy of inflation and currency devaluation, cash is trash, a guaranteed loss of purchasing power. You need to allocate a portion to gold, not paper gold, not numbers in a trading app, but real physical gold that you have complete ownership of. This is your insurance, the ballast of your asset portfolio, your Noah's Ark, when the financial system resets. Second, pay attention to silver's asymmetric opportunity. Gold is the shield, silver is the spear. Considering the current extreme gold to silver ratio, silver is severely undervalued. Its volatility will be high, which isn't suitable for the faint of heart. But if you understand the industrial deficit logic mentioned above, you'll understand why I think silver has massive explosive potential in the next 3 to 5 years. This is one of the few assets where fundamentals and price are completely divergent. Third, embrace quality assets with pricing power. I am not saying to convert all your money into metals. That is unrealistic doomsday thinking. Quality global companies with strong brand moats and product pricing power. Like those tech giants that can pass cost increases onto consumers, or companies with irreplaceable resources, are still effective tools against inflation. But avoid those zombie companies drowning in debt and surviving on cheap money. Because in an environment of rising capital costs, they'll be the first dominoes to fall. Listen, those in power will do everything they can to keep this game going. They'll cut interest rates, they'll do quantitative easing, they'll change the CPI calculation formula, manipulate the data so you can't see the truth about inflation. They'll tell you everything is under control, that the economy is about to have a soft landing. You can choose to believe them, believe the official narrative that promised inflation is just transitory. Or you can choose to believe this cold, hard data, history repeating itself from 1967, 1,000 tons of central bank buying, the rewriting of Basel III rules, and the depleting silver reserves. On this narrow path to wealth, timing is everything. Now is not the time for panic. Now is the time for positioning.